Please join me in welcoming the students participating in our commercial real estate job shadowing program, which pairs rising college juniors and seniors with industry professionals for the student to learn about their job in the commercial real estate industry. We have over 40 students in attendance today from the University of Texas at Arlington, Southern Methodist University, the University of Texas at Dallas, Baylor University, Collin College, and Tarrant County College. Thank you to all of our mentors for agreeing to share part of your day with these students, and also to our planning committee who arranged all the logistics for this program. This program is made possible by your involvement. Lastly, this is my last opportunity to speak to everybody from the podium as the tenure for my presidency of the organization is coming to an end. It's been a real honor to represent all of you, serve alongside the rest of the and work alongside our tremendous staff. I want to thank all of them for their service and encourage the rest of you to consider joining the board. It's very rewarding, very fulfilling, and can be very profitable because there have been numerous board members through their relationships who have increased their business. So I highly encourage you to consider joining the board. Okay, with that, let's get into the program. A quick note about audience Q&A. If you have any questions you'd like to submit, go to menti.com, menti.com, and enter the code on the screen. Once you submit the questions, they will be visible to our moderators here on this screen, and they can work those questions into their discussion as they are able. Feel free to submit questions throughout the program. There's also, I believe, a QR code on the program packet on your table. Now, I am pleased to introduce to the moderator of today's event, Scott Lewis. Scott is Executive Vice President of CBRE Capital Markets. He has successfully originated, structured, and closed hundreds of transactions with an emphasis on institutional quality assets. We are thrilled to have him as a moderator. We are thrilled to have him moderate our discussion this morning. Please join me in welcoming Scott. Do you need that? I don't appreciate it. You're welcome. You don't need this, do you? Okay.
Good morning. Let me introduce our esteemed panel today. Let me start with Robert Dorzell. Robert is with United Commercial Development. He is the principal, owner, and CEO. Welcome, Robert. Aaron Eccles is with Frost Bank. He's been with the bank for 12 years and currently runs the commercial real estate lending division. Peyton Mays is the CEO of JPI and a national developer and operator. And finally, Jack Fraker. Jack is the global head of industrial and logistics for Newmark. Okay. Well, we find ourselves in interesting times. We've had quite a reset in valuations that has been the result of a run-up in interest rates, which has been phenomenal. Meanwhile, commercial banks, who are typically the biggest source of liquidity for the business, are on the sidelines for a large part, and those that remain are facing some headwinds. So with all that in mind, I wanted to start out by letting Aaron kind of tell us what is going on with interest rates, and can you give us just sort of the groundwork to have our discussion today? Thank you, Aaron.
Sure, thanks, Scott. So as Scott mentioned, there's obviously been a huge run-up in interest rates. Everybody in this room knows about that. I was looking, and I think prime was at 3.5 in March of 22, and 12 to 15 months it ends up at 8.5. So that obviously impacts everyone's world. The banks are having to deal with that from the standpoint of loans that were underwritten at rates of 3.5 to 4%, with maybe them being kind of shock tested to hit a 6 or 6.5% interest rate, and what's your coverage at that high end. We've obviously blown past that. So you've got assets that are performing at or better than what you originally underwrote in terms of rents or occupancy, but now are maybe not even providing break-even debt service coverage. And that's made for some tough conversations where nothing within anyone's control has slipped, but we've now got an asset that can't service its own debt. And it's not like your home mortgage payment, where as long as the check clears, nobody cares, right? When we have the regulators come in, they want to talk to us and know, how are you classifying this loan? If it can't service its own debt, it's great that someone's carrying it, but that's not something that you can rely on for the long term. So you probably need to slide it down your risk grades, which means you have to set aside more capital. And in a lot of instances now, the bank maybe finds themselves losing money on those loans, right? From their cost of capital. And then you're also trying to figure out, is there a way for me to go and make new loans? And that has to take into account, do I have liquidity to lend out? How much of my deposit base was I lending out before any of this started? And if you were pretty highly lent out, if you're not seeing loans be repaid through a refinance or an asset sale for the debt service coverage reasons, for someone not willing to buy it, then those loans are staying on the books. You're not able to redeploy that capital. Do you have any additional capital? Well, that also then depends on how was your bank managing its balance sheet. Was it making investments in long-term deals that provided a higher yield, or were they matching it up more with their liabilities as well, that tend to be on more of a short-term nature? And then in March of this year, you have the panic where a couple pretty specialized banks found themselves in a situation where liquidity was leaving really quickly. And so nobody acts rationally, and we start to try to pull a bunch of money and put it somewhere that we think maybe it's safer. And then on top of that, now rates are up and people are paid for their deposits. So a whole host of things, right? It's causing you to set aside more capital. Assets aren't performing, even though there was nothing that could have been done differently. And then we're also trying to figure out, do you have liquidity to lend out? And so then everybody wants to know, what are we looking at as far as interest rates? Are they going to go up? When are they going to come down? And Holland, if you'll pull up those slides, put together just a little bit of a look historically speaking. This is a graph that's put out by the St. Louis Fed that shows the 10-year Treasury historically. This first one actually just shows it from 2009 until today. So even today, we are only slightly above what we were at in 2009. But if you put it in more context and you look at it from, I think, 1963 to today, out there on the far end of the right, we're still very much on the low end of what was historically normal. And if you take just certain chunks of time and look at the yield and see how it compares, 62 to today, the average yield was 5.88 on the 10-year. If you look at the 70s through the 90s, where there were periods of inflation, there were obviously issues in Texas with energy and with commercial real estate. There, the yield jumped. The average yield was 9. If you just look at 2003 to today, where we started with that graph, the average yield was 6%. Most of the folks in this room, our memory or our careers really only go back to 2008 for the real estate world. And there we see part of the problem, right? The average 10-year yield was 2.5. So we're in this weird space where...
A little bit of a floor for cap rates. So you deal with this day in and day out. Tell us what you're experiencing in the investment sales world.
Well, these high interest rates are definitely not helping in the capital markets. And our company and other publicly traded companies have seen their capital markets revenues go down as a result of that. I mean, I do remember those cycles that he's got on the screen. I don't know if the audience can see it, but the late 1980s, early 1990s was in Texas was the RTC era, and that was it's kind of localized in Texas, but it killed the capital markets in the Dallas and all these markets in Texas. We've had some other cycles over time, Scott. As you may recall, we had COVID. We had the great financial crisis. We just talked about the RTC. And we always get through these cycles. So it's a period of pain for a while, but we'll get past it. It is affecting cap rates. In our particular asset class, which is industrial real estate, the fundamentals are so strong. There's very robust and tangible rental rate growth. For most of my career, we had to infer the possibility of rental rate growth to our investors because there was not any evidence that rental rates moved very much. But now they move dramatically, and it's an overused expression, but it's really accurate. You can mark these rent rolls to market. And investors look at multi-tenant buildings, for example, and they look at the vintage of the rent roll like they're looking at a bottle of wine. And they might say, gosh, there's a 2010 tenant on that rent roll still. That's a great vintage year, because I know that with one hand tied behind my back, I can increase that tenant's rent, 20 or 25%. There's examples like that all over the United States and here in Dallas-Fort Worth. And you can still buy a good vintage rent roll that might be only 3 or 4 years old, and those leases are below market. I'm only belaboring that point because none of these investors want to use negative leverage, but they might do it for a couple of years if they can see that if they can just hang in there for a couple of years, they can increase the NOI to such a level to cover the debt, which is very expensive nowadays.
Well, thank you, Jack. Well, Jack touched on strong fundamentals for industrial and multifamily, grocery-anchored retail, which are the specialties here for Peyton and Robert, are also holding up very well fundamentally. But I am curious, as developers, kind of what you're experiencing with new deals when you go out to the market, go to your go-to banks for a construction loan. What are you experiencing in terms of interest rates, structure, pre-leasing requirements? Peyton, I'll start with you.
Yeah. So we develop multifamily, so it's always spec. No pre-leasing. I would say that during these times of capital market dislocation, that tell a team, you sit around the investment committee table, and everyone's having the same issues, right? It's tough interest rates, and lenders are more risk averse than they used to be. But I look at that as try to be glass half full, and relatively speaking, I would prefer to be at a place like JPI during these times where long track record. We've been around 4+ years, developed about $18 billion of stuff, 370 some odd communities developed. And so during times like this, I think we're the beneficiary. We're getting less leverage than we used to. We're paying more than we used to. It's the banks are asking for more structure than they used to. But relatively speaking, we're still getting things done. We have a lot of great go-to capital partners that have long-term relationships with. But we've expanded that. We're always looking for new ones. And last December, we closed we closed 6 new construction starts last December, and 2 of those were with a new bank here in DFW, and I've done another one since then. So we're always love our existing banks, but we're always looking for new banks. And again, when things get more risk averse, I think a track record is really important.
Thank you. So Robert, what's your experience? It sounds like things have held up relatively well for Peyton, and you guys are certainly a preferred developer. But are you seeing any challenges when you go out to the market? Are you seeing anything different than more normal times?
Well, unlike Peyton, I think we have 8 employees, so we don't quite have the firepower that a JPI has. But in retail, it's very you have to be very creative. It's a little bit more creative, I think, than maybe. I mean, sometimes I wish I was a multifamily developer or industrial developer, but you have to be more creative. There's lots of different ways to kind of get the deal done, whether you're spinning off to an anchor and buying the tract with the anchor, and then they're sharing in the site work, or maybe selling off to some pads or something like that, or maybe doing a ground lease. we've had very good partners over the years that have been willing to sign notes, sign the guarantees, and so that's been able to, we've been able to get some really good financing over the years. But even now, even with some of the stronger partners that we have, the banks, like you were talking about with the Fed not being able to with the Feds coming in and
risk grading
and so forth. I mean, you might have a great guarantor when in the past you guys are going to go, hey, we got this great guarantor, and so it's no big deal, and they're like, no, you guys need this thing isn't debt covered, and so we need to. So the banks they don't have the flexibility now that they used to have to be able to kind of sweep things under the rug. I mean, 10 years ago we were getting financing, 100% financing in some of our deals. I mean, which is pretty amazing with the really strong guarantors. And now, I mean, we just closed a loan recently with just the normal parameters of what the NOI was going to be and the debt coverage and everything. They said they could only get us up to about a 60% loan to cost. Well, the project had been approved at, I think, 75% loan to cost. So, that tends to, cause some issues for your partners where you got to go back to them asking for more money, or, in this case, we were able to work out some pretty creative things, but it was really due to the fact that we had, it was on a Kroger anchored grocery store anchored where they were on a ground lease, and we had a lot of great pre-leasing, and we had a lender that had that we had a very good long relationship with, and they really wanted to do the loan, so in that case we were able to get it done. But I've got a lot of friends in the market that are, I think that 60% loan to cost is kind of like the new, where we used to be able to get 75, 80, even like I said, 100% in the past. I mean, those, we're not able to see that anymore.
Hey, Scott, I could add one quick thing. I'm not a developer like they are, but in the industrial sector, there's really strong fundamentals and constant tenant demand. In fact, record absorption and leasing activity. But with the lending environment, many of the developers are just not going to be able to get their deals put together. But that could be a sort of a silver lining for operators in the year 2025. It takes these buildings 9 to 15 months to build an industrial building. So if we have constant tenant demand for the next 12 to 18 months and less supply due to financing constraints, there's going to be more demand than supply in 2025. So smart developers are trying to get their equity put together, put some projects together so that they're delivering in the first half or first quarter of 25, and they can get an additional boost in the rental rate growth I was talking about if they can time it just right.
That's great. That leads me to a question, Jack, for the group, and that is, what is getting done today? We've talked about what's not getting done and some of the headwinds. Jack, in your world, we'll start with you. Who's winning deals today? Has the profile of the winning bidder changed? And kind of who do you think is getting out there and making good deals today?
Well, there's right now there's investors that can do a deal all cash and make that claim in the middle of the intense buyer interviews that we do. We ask everybody, what's your capital stack look like, and what about these interest rates? And if their answer is, we're going to close this deal all cash, we still ask follow-up questions. But the ones that can do all cash deals, that's great. So we're working with those kind of groups. If the groups tell us, we know it's our cost of capital is going to be higher than the cap rate that you're trying to sell this property for, but we built that into our financial model and we can absorb some negative leverage. If they give a smart answer like that, those kind of deals are getting done. I will say we've had a couple of deals recently where the investor said, I'm going to do all cash. And that was during some of the most volatile periods of time of 10-year treasury movements. And some of those groups stayed the course and closed those deals all cash. We had a couple of all cash buyers that said, I know I told you all cash, but I have to measure my returns and results and pro forma as if I was getting financing. And so to make this deal work, I've got to adjust the price. So there's been a little bit of that happening. I mean, not rampant, but there's groups that stay the course and close all cash. And there's a few guys that bring out the arithmetic and show us how their yields have changed.
Okay, thank you, Jack. I wish my eyesight were better. I could read these questions, but
It's talking about your 100 million net worth. It's a question about if you had 100 million.
Yes.
Yeah.
And Jack, I appreciate your unleveraged comment, but we all agree that keeping properties unleveraged is un-American, so please finance
Oh, yes.
whatever you own.
Amen.
All right, so Aaron, I have a question for you. You kind of got into some of the challenges with the banking world. Let this group in. Let us know what's happening behind the scenes. What are really the strongest headwinds in the industry, and how do we get out of this? If banks have balance sheet issues that they're dealing with or regulatory issues, how do we push past and get to where banks are providing liquidity again?
Yeah, I think our CEO has said the liquidity you have in a crisis is the liquidity you bring to the crisis. And certainly in the current environment, it's tough to buy deposits and then still lend that stuff out. If you're having to pay for the deposits, you're going to obviously have to charge more to lend it out. I think a big part of it is just hopefully there's some certainty that requires the secondary markets to thaw a little bit, where once people understand, okay, here's the rate environment we're going to operate in, then I can start to make some of these decisions like Jack talked about on, whether I want to buy a property or how much do I want to finance it and how do I want to structure my capital stack. Because one of the headwinds for banks is, when things were going well, we couldn't keep a construction loan on the books. The moment it's done, somebody wants to buy it, they're willing to take up lease-up risk, we get paid off. And now that stuff has frozen. People are not wanting to sell an asset or they're not wanting to refi an asset because they don't want to lock themselves into a fixed rate where they have some sort of a breakup penalty if rates decline in the near future. There are some folks where things are tied up. They don't have a lot of capital to redeploy. But I think hopefully once we feel like people can feel like, okay, we at least know rates are going to level off, even if we're not banking on rates coming down in the near future. That'll free up some capital for at least some large stuff to come off the books. We still have plenty to lend today, but as everybody alluded to, it just looks different. It's all based on your NOI debt service coverage. And so we're still able to do deals provided you've got enough equity and it makes sense for you to put in 40%, right? Because that's what is required to hit your debt service coverage hurdles. So we need the secondary markets to thaw a little bit, and then we just need those projects and the sponsors that it makes sense for them to go much lower leverage, I think, for things to really get moving again.
Perfect, thank you. Okay, Peyton, we've got some multifamily questions for you and development specific. Tell us about what you're trying to solve for when you're looking at a deal. You and I talked about this a little bit. It's a little bit more challenging for you to get deals to pencil today, but what kind of return on cost are you looking at, and just what is the market giving you today, and what's realistic in terms of return on cost?
Yeah, so our return on cost, kind of untrended return on cost, if it doesn't have a 6 handle in front of it today, then it's extremely difficult to capitalize. Again, that's untrended, so 6.25-ish, 6.5, and then trended it can get up to 7. Although rent growth is definitely different today. Forecast is different today than what it was a year ago. But yeah, those are the metrics.
Okay, perfect. And while we have you, I want to ask you a little bit about multifamily in general. There are some folks that say that there's a little softness on the fundamentals. Do you want to speak to that real quickly, and particularly about DFW?
Sure. Yeah. So obviously we live. Excuse me. I'm sick, and the capital markets have made me a little bit sicker. But anyway, so I apologize for the cough. Yeah, the fundamentals. I mean, DFW. I think we are so. I've been at JPI since 2019 in previous life. I did real estate, private equity, and did stuff all over the world. And when you take a big step back and you think of, okay, where do I want to invest? There was a question somewhere I saw on the screen. If you had $100 million, where would you put it? I, of course, put it in multifamily development. That's unbiased. But no, fundamentals DFW. I think we're so blessed to be in this part of the world. If you take a big step back and look at everywhere else, I think DFW has a ton going for it. Y'all may have seen that article came out a month or two ago, but talked about population projection in, I think it's 2100. So, it seems like a long ways away, but my kids will, Lord willing, they'll be around in 2100. DFW, I think it was the Metroplex was just shy of 34 million people. Houston, 31, I think, and Austin, 22 million, the three largest metro areas in the country. And I was talking to an economist last week. I said, what do you think about that, Jay? And he says, I can see it. And so we live in a great place, and there's a lot of people still wanting to move here. There's a lot of multifamily on the ground today that needs to be scraped and redeveloped. That's something that we're working with different municipalities on as well. So I'm, short term, maybe a little bit sick, but long term, extremely bullish.
Perfect. Okay, so one of the questions that was asked was, what happens if rates don't come down? We are investors kind of going to be out there taking risks that they shouldn't be taking if the assumption in everyone's mind is rates are coming down. So I'm curious, Robert and Jack, what you think about this, particularly, since you've worked in higher rate environments. What does the world look like if these rates are here to stay? And Robert, I'll start with you.
Well, I guess on the new development stuff that we're doing, I mean, we've been sure to get loans that have at least 3 years of interest only. And so, I mean, in the past, there's been some lenders that'll only give you 1 year, 18 months, and then you have to meet some parameters to extend or something. And I mean, that would really be a problem right now. So having 3 years is really, really important. I mean, I don't know. It seems, from talking to some of the people that know a little bit more about this than I do, I mean, I think that there's some products maybe being invented that would allow, maybe retail and some of the other asset classes to be interest only, yeah, rather than amortizing, and still be able to kind of keep the asset, so you don't have the debt coverage ratio that you have with an amortization. So things like that. But I mean, at the end of the day, I mean, I know some of my partners are having to pay down some loans, and I mean, even I've got some things that the banks are talking about, maybe having to make a small pay down just to get it right sized for the current interest rate. So, I think that that's going to be the situation. You'll have to put more money in deals.
Yeah, and as Aaron pointed out, these rates that we're experiencing really aren't high on historical standards, but maybe it's just an issue of timing and kind of more predictability rather than the rates themselves. But Jack, do you have an opinion on that? You've been in this business through high rate environments. What if these higher rates stick for a while?
No, I agree with what you just said. Historically, these rates are low compared to previous cycles. So over time, if they don't go down, then pricing will have to adjust a little bit. I mean, the cap rates, unless it's a special situation, they could increase if interest rates don't go down. I mean, for years and years, I would say there was not a direct correlation with interest rates and cap rates. It was usually cap rates were property specific, but now it's pretty obvious there is a correlation with interest rates and cap rates. So if they stayed at this higher level for an extended period of time, then probably it would impact cap rates. I will say though, as we're all in the real estate business, and as a perfect asset investment model, real estate is great for a CIO at a pension plan. It provides reliable, predictable returns for the retiring employees, and you can't get that same kind of predictability in the stock market, the bond market, other investment models. So we're still going to be popular worldwide, real estate in general, even if it's this high interest rate environment.
One of these questions that I've been trying to avoid is about office, but I guess we need to deal with that. And unfortunately, we don't have any office folks on the panel. I think trying to peg a cap rate in office is a real challenge, as anyone in the business knows. And, in the world of have and have-nots, these are the haves up here, and the office folks are really struggling today. And, not only do you have capital market pressure, but you've got pressure for occupancy and tenant demand. So, what I've seen is the financing is really dried up for office for the most part, other than, AA, best in class. I think most cap rates, if you can find them, are in the high single digits or even low double digits. So, we can speak more to office if you want.
I can make one comment on it, which is it is a secular change on work patterns that started during COVID, and so it's affecting some markets around the country more so than others. Washington D.C., which is full of federal employees, they're not going back to work at all. All those office buildings, which are great office properties in D.C. and suburban D.C., they're not occupied because the government employees are not going back to work. You look at markets like San Francisco and Los Angeles with some social challenges in those markets, and nobody's going back to work there. However, long term, I think offices can come back, and Manhattan office space has returned, is coming back very strong. There's other markets around the United States like that. There's a few cases where office buildings have been torn down, and something else has been developed there for a greater and higher use. There's residential conversions of office properties. There's some Dallas-Fort Worth office buildings that have been torn down, and they're going to build a warehouse on those sites. So, but long term, I think office can come back.
Jack, can you speak to that a little bit more? Redevelopment, we've seen it, I think, particularly with industrial, but you mentioned some office redevelopment. Also, you've seen it with retail. Some malls that have been redeveloped. Can you speak to those trends within DFW?
I mean, the mall conversions was really big about 12 years ago. I think 6 or 7 malls were torn down and they built industrial parks. Now it's a case-by-case basis. I mean, I mentioned the office buildings out by DFW Airport that are being torn down, 2 or 3 story office buildings, pretty nice buildings. Maybe they're only 20-something years old, but they're being torn down for industrial. There's not a whole lot of examples of that. Some of the older infill markets like Brook Hollow, which is 75 million square feet of tenants, and those tenants haven't seen a new building in 74 years, right? So if somebody builds something new and redevelops an old warehouse over there, that'll be successful. Mm-hmm. I mean, in the past 5 years in the industrial sector, it's been more exciting for the developer to build a 1 million square foot building and go out there and cut the ribbon with the mayor. And so it's not as glamorous to build smaller buildings on some of these redevelopment sites, but that's where there's a lot of opportunity, in my opinion. The tenant base in Dallas and around the country really is mostly smaller tenants. It's not everybody's a 1 million square foot tenant. So if you build a product that adapts to the majority of the tenant profile, that's what developers should be doing. That's what redevelopment is.
Well, perfect. Okay, Ken asked me to keep a little time open for Q&A, but I do want to kind of wrap up by asking, are you bullish or bearish on 2024? And I'll start with the banker. Aaron, what do you think?
Yeah, it's funny. I think if you had asked me 9 months ago, people were talking about, second half of 23, we're going to have rate cuts. We'll get back to normal in 24. And I had lunch with someone from a title company a couple weeks ago, and they said their client's new slogan was survive until 25. And so I think, there will still be deals to be done, but we've talked about what it requires. And I think we've just got some time that we've got to work out these deals that were originated on the, low to free money rate environments. So I am hoping that it kind of stabilizes if we have rate certainty, but I don't expect any real upticks in return to anything we're used to from the last 6 or so years.
Okay, anyone else want to tackle that? Robert, you pessimistic or optimistic about 24?
About retail development? I mean, the demand from retailers is as strong as it's ever been. It's just that there's, we're getting calls from people that want us to do deals with certain retailers, and I mean, they're not financeable. I mean, because you just don't have any certainty about what's going to be worth when it's done, and then also just like they were talking about with the debt service coverage ratio. I mean, unfortunately, the lenders are, you know, if prime is at 8.5% or something like that, I mean, that's what they're using, you know, as the debt service coverage, you know, to figure debt service coverage ratio stabilization, they're using 8.5%. And so, you know, it really keeps your leverage down to that, you know, 60% loan to cost. And, you know, I'm finding more and more that some of the investors are kind of wanting to stay cautious and maybe, you know, hold their money for, I saw one of the questions that said, what would you do with $100 million? And I mean, I think that if it were me, I would probably keep it in a money market earning, you know, 5%. And just kind of wait and just be ready to pounce, you know, and maybe there won't be any opportunities, but that's still a pretty good rate, you know, just you know, a totally risk-free 5% yield, and maybe even a little bit higher than that now. So I don't know. I mean, I can tell you that, I mean, all the grocery stores that we work with, they're all super aggressive. They're all wanting to get sites. And so, you know, to the extent that you can, you know, you can put a deal together. You know, one of the deals that we put together most recently was actually a joint venture with a landowner. And that's actually a pretty good strategy, because then, you know, you don't have to borrow as much money because you have the land already and you can use that as your equity. So it makes it a lot easier when you go out to get a development loan if you don't have to borrow, you know, 20, 30% more to buy the land too. And then you also don't have, you know, you don't have a gun to your head to close if there's like problems with your loan. You know, you kind of all in it together, you know, where you've got, you know, makes it a little bit easier. And when you got stressful times to have, you know, where you don't have that extra stress to close, you know, your time is running out in your contract and you're like begging for more time and stuff. I mean, it's better, you know, it's sometimes easier if you have a joint venture. And I've known some other developers that are really focused on that too, especially because a lot of the landowners, they haven't decided, they don't want to drop their land prices, right? So they can put in their land at a reasonable rate, and then they can participate in the upside and still make, you know, quite a bit of money doing that way if it's a successful project.
Hey, Scott, I just have to, Peyton probably wants to answer the same question, how he feels about 25 or 24 next year. But I personally am optimistic from the industrial real estate perspective. There's things going on such as nearshoring and onshoring. In the state of Texas, you know, Samsung's building a $25 billion plant in Austin, not 25 million, $25 billion plant in Austin. And that's onshoring, you know, chip technology coming from Asia. So that in and of itself is going to create tremendous tenant demand in Central Texas. There's also examples of data centers all over the state of Texas and the country. That's another reason to be optimistic. And we're trying to claim the data center sector as part of industrial, but it really is starting to happen. And then nearshoring, which is our neighbor in Mexico, is seeing tremendous activity, and that affects all these border cities in the state of Texas. So we're really optimistic about the industrial sector for 24 and 25.
Yeah, I'll say as well that we're optimistic. I'd say we will likely not sell much in 2024. But from again, take a big step back, big picture, optimistic. I mean, we're in markets like this, you know, you have to buckle down. You're working with your construction and pre-con teams like, okay, guys, we have to figure out ways to save costs. We're our own general contractor as well. And those have been very healthy discussions that will live well past this, you know, capital markets dislocation, as well as, you know, attracting people. I mean, JPI is today roughly 300 folks. And the quality of talent that we're able to attract in this market is very, very encouraging. That will live well past this capital markets dislocation. So, and you know, anybody can make, or I shouldn't say anyone, most people can make a deal pencil, and you know, LIBOR or SOFR's 1%. And, you know, you got a lot more capital than projects. But I think in this market is where you really, you know, separate the folks that, you know, can get stuff done, the folks that can't. And today, when we put a shovel in the ground, we forecast to make less money off that deal today than we would have 2 or 3 years ago. If you look back in the past, development, if you can get a deal started, excuse me, if you can get a deal started when it's hard to get deals started, usually when you sell those things, in multifamily, got a longer time period, roughly takes 3 years, that cycle, you're usually setting pretty well. And there's I think I read the other day, there's 240 some odd billion dollars of capital, kind of an all-time high that's kind of on the sidelines. It's been raised to invest in real estate. And so I think we're in a good spot to attract more than our fair share of that. So 24, don't look to, we probably won't sell that much stuff, but I think it's going to be a great time to set the foundation to grow.
Okay, perfect. All right, Ken asked me to take some live questions here. So if anyone's brave enough, just raise your hand.